Good evening, everybody, and welcome back to another episode of One Big Stock Market Sundays with me, Will and Jordan. How are we, lads?
All good.
Yeah, all good. How are you?
Yeah, good, man, good. Busy weekend. You lads been up to much this weekend?
Just watching the football, really. Unfortunately, just watched that 4-1, so bit of a shame, but I think it was probably expected, wasn't it, really?
Yeah, definitely, man. So to start off for this stream straight away, we're going to touch on the predictions from last week. So, George, do you want to take over from here, mate?
Yeah, so most of us went green, apart from one silly sod who went red. The week ended up green. But I think sort of the main story of the week is that Stream have got their first point. Out of 6 tries, they've got one right. So hopefully they can roll on and build up some momentum from here, and maybe catch down some of the others in the list. So we're starting to spread out a little bit more now on the scores, and of course, as always, we'll come back to new predictions for the week ahead at the end.
I think it just has been so hard because, in one sense, like it's not really been green or red. It's just sort of sideways chop, isn't it, for the last 5, 6, 7, 8 weeks? So it's very, very tight each week. But yeah, like the general market has just been like a massive sideways chop right now.
Yeah, and that's the problem, isn't it? It's like trying to, like you say, we're finishing, evening, Rob, we're finishing pretty flat each week. So it's literally just about where the market actually opens on Monday, more about where it actually closes. It depends on how the weekend sentiment goes. But yeah, like I said, we're starting to notice a bit of a gap now. Will's leading the charge. Stream's getting their first point, so it's good to see. But yeah, so we'll touch back at the end of this. We've started a poll now for how the stream thinks we'll finish next week. So make sure you get your votes in, and we'll be presenting ours at the end of the stream. So first things first, Will, you're going to take over and touch on what you want to touch on, mate?
Yeah, so as usual, we're just going to be looking at gold, silver, the Dixie, and a little bit of crypto as well. And overall, it was a pretty strong week for precious metals. I think there were a few catalysts for that. The PCE data, the inflation data came out on Friday, which we'll touch on more later. So I think because it came in a little bit hot, that kind of pushes people to precious metals a bit more. So gold almost 4% up for the week. And I think it's still just been really quite volatile over the last over the last month or so. I've seen the classic different opinions where half of people are saying it's top tier at about $5,500 an ounce, and other people think that it's going to go back up and then break that high. So I think this will be an interesting watch over the next 2-3 months to see whether we can break that high, or we just settle in around the 5,000 mark and just keep chopping. Silver as well, really saw that catalyst on Friday. So that's actually 8% just on Friday. So we had the tariff cancellation. Of course, so obviously that will come to that soon. So we had the tariff cancellation, the PC data, the GDP data. I think that general trend is sell the dollar, buy metals a bit. So 12.5% for the week, 8% just on Friday, and still year to date is 17%. So again, it's very, very similar to gold. So we're nowhere near that high or around 120, but will we get back there or won't we? Obviously, no one knows exactly, but at the moment we're just chopping. Dixie, the dollar index. This here is exactly when the tariff announcement came out, the Supreme Court decision. So overall, and I'll go into more detail in a few minutes, but I think this was sort of bearish dollar overall, but then still at 1% for the week. So I think it just had it's like a sort of usual chop really for the week. And finally, Bitcoin still struggling, still hasn't been a asset which people have wanted to go into, to be fair, even with the disruption to various markets and like the dollar weakening, etc. a little bit. So pretty sideways, still around 67, so almost a 50% drop still from its high last year. And it's still 30% down for the year. So difficult for Bitcoin, and obviously we are in the 4-year crypto cycle, as I've mentioned a few times now. So again, this is just one to monitor. I'm not sure where this one will go, but yeah, still pretty weak right now. Should we go on to the main beefy topic of the week then? And Friday, some big news came out, didn't it?
Yep, about the tariffs being cancelled by SCOTUS. So, Will, do you want to lead the charge on that? Can you? I know you like touching on this subject quite a lot.
Yeah. So the Supreme Court of the United States came down finally, because I think it was the third or fourth time that it was supposed to come live. 6-3 against the use of the tariffs, or certainly the way the tariffs had been used by Trump so far, which is obviously huge. But like, there's just so many different tangents of what it means, what's going to happen, kind of where we go from here. It's kind of funny to think back, though, just before we sort of delve further into it, that so last April we had a Liberation Day, then the market ended up bottoming on the 9th of April 2025, and we had such an amazing bottom, a buying opportunity, and it just shows that, well, we were sort of lucky in one sense, because in the end that didn't need to happen, because it was ruled because it was ruled that it shouldn't be allowed.
The market didn't really know how to react on Friday as well, in my opinion.
No.
When it first came out, it went up. It's almost as if, like, I know we've had these conversations before, and the market don't necessarily like tariffs. But everyone can have their own opinions on what they think of that. But obviously, the market as a whole don't necessarily like tariffs. So yeah, when it first got announced, the market actually, I wouldn't say rallied, but I'd say drove a little bit off the news, and then obviously, yeah, it started dropping again on anticipation of what comes next. And obviously, we've seen what come next in Trump's speech on Friday night. So, I mean, what do you think on this, Joe? What's your take on it?
Yeah, I mean, it's almost weird to think that it's coming up to a year since this whole sort of phase kicked off. Has been a year, and almost to the year later, you have like a next sudden turn. And I know it affects a lot of effectively revenue that's been generated by the tariffs. I think the number is 133 billion in terms of what it applies to being decided on as being illegal, or wasn't really able to do what he did, and then bringing in that blanket 15%. There's been comments saying that it makes up the money, or actually brings in more money. I'm not sure that is the case, because I think their average across the companies they put tariffs on was higher than that. So we'll kind of have to wait and see how some of the numbers play out, and also ourselves look into the numbers a little bit more and sort of theorize what they'll look like, and if it is a either equaled in the effectively revenue generated by the tariffs, or if it's more or if it's less, and by how much. Because I think it had already been factored into a lot of the spending. We'll mention in the Discord server this week about the military spend, like the increase in military spend in the US. A lot of that is sort of covered by those tariffs and the extra revenue there. So it has a lot of implications in many layers of the US, and to almost have that like cut off effectively until the 50% blanket sort of replaced it, has a lot of ripple effects in many different ways, as you say. So I think another one of those things where it's partly to see how it plays out and what it really means numbers wise. I don't think it's a great look for him, and at the start of his initial speech he did seem a little bit deflated with the verdict. And then since then he seems to have just said a lot of like catchphrases and buzzwords and stuff, and just sort of filled the space with things that people want to hear. I think it's a blow, and I don't think he would have been personally sort of expecting or planning for that to happen. So it will cause a shake-up for sure.
Yeah, so when he did that press conference on Friday, he was deflated for sure, and then I think during that he kind of pumped himself up and kind of got himself going. But he did say on that Friday press conference a 10% global tariff now, I think using section 122, which is which is designed for balance of payments deficits. But these tariffs have a 150-day clock, so they are temporary. So it does give him time to try and get congressional approval, perhaps for the original tariffs, or to try and do it without just using the power of the president. But then I think over the weekend he's probably stewed on it a bit and sort of got more frustrated, because then it's come out that he's now announced on Truth Social the 15% global tariff. So I think he's kind of ramped it up as a bit of a FU to SCOTUS, that rather than 10 it's going to be 15, or possibly it's sort of been like, well, actually, mate, we might need 15 because you've committed so much spending to so many different things. We actually need that money. But if you look at like the winners and losers, I think like the EU, the UK are sort of a level to slightly losing out, because they agreed deals sort of 10 to 15%, whereas China and some other Asian countries have come way down because their tariffs were 20, 30, 40, 50%. So it does create a bit of a winners and losers. And I think in general, just for the US businesses, small, medium, large, it creates an air of uncertainty. I think it's a bit poisonous. Like, it's a bit difficult to know what's what. I think it's interesting also, like a different aspect is, so certainly prices went up at places like Amazon, Walmart, and over the last 12 months, those big corporations definitely put their prices up because of tariffs. If tariffs are going to be less, they're not going to bring their prices down. So they're like probably happy to expand their profit margins. And over the course of the last 9-12 months, the US consumer, albeit probably wouldn't have liked it, it's probably kind of got used to the higher prices. So do we see EPS being higher now? Do we see revenue being higher at those big corporations because they're possibly paying less tariffs, but not lowering prices to match the tariff changes? But also, I think it's like an element of a self-protection where they don't want to keep changing their prices, so they keep them fairly flat as they can. But if that means creating more profit for a short-term period, then they'll probably happily do that, to be fair. But yeah, it's messy. It's not a great look, as Jordan said as well. Yeah, it's going to be a mess. Actually, I think just one thing. Sorry, Jay, can you put my screen back up? So one thing in the report which SCOTUS did say is that the refund process is likely to be a mess. So they themselves say that, look, this is a total mess. We don't know how we're going to pay the refunds. And I think a lot of companies will try and sue the government, will try and get their money back. And this is a lot of money. This is a lot of money, and it will have ramifications of where they'll get the money as well. So yeah, as SCOTUS say themselves, it's going to be a mess, isn't it?
I've seen something over the weekend as well where Trump had spoke somewhere, or he'd wrote it somewhere, read it somewhere anyway, that it can take years to litigate these refunds as well.
Yeah.
So like I say, it really is going to be a mess. But again, it's not. I think total revenue for tariffs, on what I was looking into, is 300 billion. But I think only refunded is it like 140 something, isn't it? That would have to have been refunded. I believe it was around that mark. So I was doing some digging into the numbers on those. But like you say, there's always going to be loopholes. And I think obviously Trump can only, with the trade acts that he cited on Friday, can only put 15% in because of those trade acts.
Yeah.
It only allows you to go 15%. So the next step is, if you don't get his way with that, is there going to start being tariffs in the region of licenses? So you need licenses to do X, Y, Z, or is there going to be? And it depends on what channel or avenue that they go next, really.
And then just one other comment, just on the dollar as well, and we were having a discussion in the server on Friday about it, is that overall it probably does put some downwards pressure on the dollar because of the 130, 40, 50 billion, which does need to be given back. Because how will they get that money. Like the Treasury has billions of dollars, but obviously they want to spend that on other things. Will the Fed have to step in to buy some bonds, effectively, which is like basically which is basically pumping money into the system? So all these things could make inflation worse, could put downward pressure on the dollar, could be a good trade for metals. But yeah, it's going to be a mess. But in terms of the actual stock market, Jordan, how much do you think this is going to have, like, basically on our favorite stocks?
Yeah, there's a lot of unknown. I was about to say as well that I think there's another unknown of some of those trade deals that were in that previous page, like countries who have pledged to invest X amount into the US, and as a sort of reward for that, get a lower tariff rate. What happens to that investment? And I guess that leads into some of the stocks that were likely to benefit from that investment, especially energy wise. A lot of it was selling US energy and those sort of exports that those sort of pledges to invest in the US from other countries were made into. What does their future sort of external foreign investment look like and foreign demand look like? I think for our favorite stocks, I mean, like you said, I think similar to the countries, there's some winners and some losers depending on where product lines are, for instance. Maybe as an example, Apple was one who are moving a lot of their product line away from southeast of Asia and other Asian countries which had a higher tariff rate, and were shifting more to India, which has recently become a lot closer with the US and was getting favorable and more positive and lower tariff rates. And obviously now a blanket approach across everyone's treated the exact same as is the sort of like a short-term little bite in the heel sort of thing. There's just as I said, there's just so much unknown. Winners and losers for sure, and others that probably will just weather it as if nothing's happened. It's hard to pick out specific ones of that. I don't know if you guys have any sort of key stocks that you're thinking since the tariff changes, like this one looks really appealing now all of a sudden, and this one looks not so much. I know when tariffs were first announced, Nike, for instance, took quite a tumble because a lot of their production line is in, I think, Vietnam, and they had quite a high tariff rate to begin with, and does now bounce back a little bit, amongst other things that obviously are playing on the stock share price.
Yeah, I actually was going to say Nike as well. So, and I think it will be those stocks which were mostly affected by the tariffs, kind of stocks which had a lot of supply of their production in China and Vietnam, Laos, etc. But yeah, I think certain sectors will continue to do well. But yeah, it's going to be a difficult one. But again, sort of as I say every week, even though that this is major news, breaking news, I think it's still a time just to stick to the plan as well. Definitely be aware of the news, be aware of what's going on, but it's not a panic. It's not a time to sell. It's not a time to really stress or worry. Just keep doing what you're doing. Make sure that you're in stocks which won't be too badly affected by this, sure. But overall, like, I don't think it's a major catalyst to do anything crazy.
And just to touch on the back of what you're saying there, Will, I think it's important to remember, because you are spot on the money. I think it's important to remember that if, let's say, this is where we were talking about 3-day rules last week and our emotions, etc. Because if you let your emotions get the better of you, and let's say you sell on Friday because of all the noise, well, if you just sold last April because of all the noise and held cash, look at all the gains that you would have missed out on between last April and now. So I think you've hit the nail on the head perfectly. Stick to the plan. Yeah, it's noise. Yeah, it creates opportunity, but that's exactly what it is. It's an opportunity creator, not a be all or end all that the market's going to. All I'm seeing all over YouTube this evening when I'm looking is prepare yourself for a market crash, market crash imminent, this, that, and the other. And I think sometimes you've got to block out that noise and just stick to the plan, man.
Yeah, well, actually, I was going to say something about that on kind of just like thinking in general, Jay, and that how many crashes have happened where everyone's saying market crash? Like, it just doesn't work like that. Those, like, those bigger crashes happen when no one expects it. But even so, like, just thinking about over the last few months, there was probably one time where I felt, wow, like we're in an amazing bull run, like everything's going so well. And then I can show you exactly where that was. It was here. It was right early October, this sort of time. Like everything felt amazing then. Like no one thought something bad would happen. So we had the great crypto liquidation after the Trump China tweet on Friday night on the 10th of October, and then we end up smashing through that, like that kind of level there. This is where I felt, wow, like everything's going to be so good, and we're going to charge upwards, and that's when we came crashing down, and no one was talking about a crash then. So I have noticed when too many people are saying the same thing, it doesn't happen, because people are hedged to the downside. People have puts, people maybe have covered calls, people have gone more for like a risk-off approach. So in those situations, it's very, very, very unlikely that you're going to get a crash. If anything, it's going to be the opposite, and the market will keep trundling upwards. The general wall of worry will grow and grow, and that basically means people on the sidelines are going to think, oh, damn, I should have got in months ago. So they kind of are reluctantly buy into the market, and that pushes it back upwards. And only then, right at the pinnacle of that, when it feels like there's no kind of headwinds in sight, nothing can go wrong, that's when it switches, and that's when something happens. So I think you truly need, I think one needs to be aware of when things feel too good. But when everyone's predicting a crash, and it's not just YouTube, it's X, it's TikTok, it's people kind of like AI bubble, the tariff nonsense, PCE, the Fed rates, wash, so many things. But everyone's prepared for that, really, aren't they? So
I think something that people need to, I think the problem is the word crash gets thrown out too easy.
yeah,
Can you, just a percentage wise, lads? George, Will, if you we'll go down the board, so we'll go with you, Will, first. What's a percentage of the S&P dropping to you for it to be considered as a crash in your eyes?
Crash.
Like a crash. So we're talking crash. We're not talking a little bit of a correction, a little bit of dancing. We're talking crash. In my eyes, I'll go first. We're talking 15-20%. That's a crash.
I was gonna say, I think officially it is 20%.
Yeah,
But
it's 20 officially.
Yeah, I think I'd probably say the actual S&P 500. I'd probably say 12.5 to 25%, something like that.
What are you saying, George?
Yeah, I'd say 20% as well. I think the time frame a little bit into that, maybe 20% in 2 months ish to 2-3 months would be a crash.
Yeah.
If it's like over a year, I wouldn't really call it a crash. 20% is my number. Yeah.
And I think this is where I'm going to touch on this real quick here, because Ben just put a comment in there saying, I really like SoFi. If it drops, I'll see it as a good buying opportunity. Now, what I'm going to touch on that real quick, and this is where we was touching on the difference between crashes and the difference between opportunity. SoFi is nearly trading at the same level it was trading at about March last year-ish, give or take, before April happened. It was sitting around that. You've got a chart for it there?
Yeah, I do,
yeah. So SoFi last March, was it? I think it was around this level. When was it last sat there?
The 30th of June, around that time.
Okay, so we're sitting around that price of where people, like, I was originally buying SoFi at 18 originally before I averaged down and got it down to like 13. But that's what I'm saying. This is creating opportunities. I wouldn't consider that SoFi's crashed in the last year. It's still grown loads. But it's the fact of the matter is, like I say, it creates opportunities, which is a big difference to what a crash is.
Yeah, so we are 43% down. So it is quite sizable. But yeah, as you say, like I think this is I think this is a time to buy, really. It's not a time to worry. But also, obviously, on a singular stocks, you can get crashes a lot more easy, because I think if the S&P 500 crashed 15%, a stock like Hood, SoFi, AMD, that would go down, what, 50%, 60%? Something quite big, wouldn't it? So,
and you've just hit the nail on the head there with the individuals can drop a lot more, because on that contrary of things, Ondas has crashed about 300 million times this year. Do you know what I mean? So yeah, you're definitely right. But I think that's the difference of the mindset way of it, is you have to look at, is it an opportunity or is there a crash? Because then you have to ask yourself, did anything happen with SoFi to justify it going from 30 down to 18? Now, obviously, we're not going to make it about SoFi, but in my eyes, there's only tech that's really lacking there. So did it really justify that big sell-off? Not in my opinion. So obviously now I'm looking at putting my own buy markers in, and I've got buy sets, so it's an opportunity. And that's the difference. Whereas you could look at a stock, for instance, like BBAI, for instance, or Trade Desk. We'll give those two as examples. Now, they're stocks that have really had a tough time, and they've got a lot going on in the background that warrants the drops as to what they had. Whereas it's not really just about noise. It's more, they've got their earnings next week. So this is more where you can look at this, and this isn't just about market noise or an opportunity. This was about real big problems inside the business.
Yeah, I mean, this is just, it's absolutely gigantic. So we're about 84% down.
It's crazy how much
yeah, it's a lot.
Yeah, so that's the difference between, now for me, I would consider that stock as a crashing stock because of, but that's because I know the fundamentals behind it as to, well, I know partly as to why that's happening, whereas it isn't just moving because of some tariff noise. That stock's moving because of fundamentals in the background. Do you still hold that, Will?
No, I sold it out about
that stock will stick with you forever.
Yeah, it will. No, I think I sold around here, so around the 48, 50, 51.
Yeah, so I mean that's the difference of knowing the different. Like I say, I see the word and term crash thrown around far too much. Correction, you could probably go with, maybe. I think that's also got its own term. But I just think at the moment we're in a very high beta market. I just think that's the way it's been since Trump's been in for his term, and I think that's what it'll be like for the next couple of years.
It's a very similar way to where I feel. I think we mentioned it last week about people having cash ready to buy up dips and then using it all up on the first sort of little dip, and also what you sort of pin and label as a dip as well. But it's all practice, and I think just experiencing more over more months and more years what dips can look like and what little blips can look like, and then just sort of reassessing and readjusting what your own sort of identification of it is and when you decide to use cash and how much cash.
I definitely think that just doing some basic TA, like real basic kind of like 1-2 hour kind of learning, and then learning for like 1-2 hours and then trying to actually put it into practice. I think that can really, really help not buy the dip too early. So it's about having that 3-day rule, but then it's about using just basic TA and kind of understanding that it sounds so silly to say, but a stock will sort of trend upwards, trend downwards, or trend sideways. So if it is like trending in a clear direction, it needs to kind of stop somewhere to the point where the story, the thesis, matches with the price. That's ultimately what a technical analysis is. So I've been using this a lot more the last probably like 3, 4, 5 weeks, and it's made me feel so much more comfortable in not buying too early. Just giving time, just giving time, just letting things settle, and just watching where things happen, and knowing that it's almost impossible to buy the absolute bottom. But if I can buy it near the bottom, then obviously that's going to be a good buy. So.
And I think on the TA side of things, well, obviously I was thinking about this. I think maybe in the next couple of months, in the next couple of weeks, we'll sort some out between us. Probably get 1 or 2 of the lads on or something that are really clued up in the server and really do a quote-unquote dummy version of really understanding the basics of TA. You and George can touch on it. A couple of the lads in the server are really clued up on this, and maybe really giving a proper 101 couple hours of really just starting from the beginning. Now, I know we've had Alessio, I know we've had M5, but they're so clued up that sometimes it can still become jargon because of how much they know about it. But I think a really 101 lesson on this could really help people, to be fair.
Yeah. So actually, we were talking about it in the TA channel, I think 2 or 3 weeks ago. So sort of slightly different from what we've had before, Jay, but going a little bit more back to basics, but also kind of why it matters, and not necessarily looking at it from like a trading point of view, but looking at it from when to buy for your like long-term investments point of view, if that makes sense.
Yeah, and I think that's what I mean when you say like a really bringing it back and scanning it, it's actually really understanding about what each line means and what it represents and what it actually does. I think that would be really good for a lot of people, because there's not very many videos out there like that, to be honest.
No, I agree.
Have you guys got anything else that you'd like to touch on the tariff side of things before we move into the PCE and the GDP? Or
No.
okay, so someone has just asked real quick, so I'm going to get you to just give a quick example, because it's important. I said we'd keep touching on this. Do you want to touch on that real quick? A quick explanation as what that is.
Yes. So the 3-day rule is this is not related to a wider market sell-off. It's related to a singular stock. So if a singular stock, for example, has a really, really bad headline, or it has a really bad earnings, and the stock drops sort of 8, 10, 20% in about 24 hours, the 3-day rule is to wait. It's to wait 72 hours before you do anything. 3 full trading days. So if it happened on the Monday, you wouldn't do anything Tuesday, wouldn't do anything Wednesday, wouldn't do anything Thursday, and Friday would be the first day you may buy the dip, because it takes a while for the dip to actually happen. It's not instant. It takes a few days, but also just give it time to just have a look over the news. Just give out the market time to overall digest the news, and just waiting and being patient works really, really well most of the time.
And that's, like you say, that's mainly a big thing around it, because I'll offer my 2 cents as well, is it's really about emotions, not buying the dip when a dip is 2% or 3%. It's about letting the market settle, letting the market breathe, and then obviously using those 3-day rule. But like I said, we touched on it last week. We will touch on it probably most weeks, just dropping it in there, because I do think it's so underrated and most people don't actually know it or know how to incorporate it properly. So I think it's important.
Right, should we jump into some macro data?
Yes, man.
So I mentioned this, I think, last week, but yeah, so I think this is the best. I think this is the best website to get the data quickly. It comes out straight away, and the key pieces of data we had on Friday was GDP and PCE. So GDP came in at 1.4%, and the consensus was actually 3%. So it was quite a big miss, like a real gigantic miss, to be fair. Although most of that can be put down to the very large government shutdown. So I think we're looking at about 1.15% has been taken off due to the government shutdown effectively. So this should be around 2.6%. So it still does miss 3%, to be fair. So that doesn't sound great. But also in terms of like the G7, like the Western countries, the US is growing by far the fastest. So it's not a good number, and some of that is down to and some of that is due to the government shutdown. But also, I don't think it's too bad either, as well. And then if you want to go kind of more delve into it, you can kind of see a breakdown of what was what, and you can see that, and right here, that the government took off a massive slice as well from that. And then if we go down to PCE, so I mentioned last week when we were looking at CPI that PCE inflation data is the Fed's preferred method of looking at inflation. So their 2 mandates are to keep prices stable and low at around 2%, and to keep as many people in a job as possible, effectively. So the core PC price index year over year came in at 3%, which is a miss. It was supposed to come in at 2.9, and the core PC price index month of the month was 0.4, also a miss. That was supposed to be 0.3. So I did go over this quite a lot of detail last week when we looked at a consumer price index, but the reason why this kind of matters is because, well, it kind of matters because the Fed is less likely to cut rates if inflation's sticky. So as I said, their target is 2%, and we came in at 3%, and that is quite a big difference. So I would say 2's fine, 2.1, 2.2, maybe 2.3, but anything over sort of 2.6, 2.7, that's starting to get into like a sticky kind of environment. And it's very difficult for the Fed because they've got the labor market, which is absolutely screaming out for a cut. I mentioned last week that over 1 million jobs actually got taken away last year after they looked at the data kind of better. So the job market really, really, really needs that cut, whereas inflation arguably is almost saying actually raise rates rather than lower rates. So they're sort of being pulled and pushed in kind of in both ways, really, in a real sticky inflation environment. And also spending grew by 0.4%, but the personal saving rate dropped to 3.6%. So it's kind of showing that high income households are benefiting from the stock market and generally owning assets, whereas the rest of the country are sort of dipping into their savings, using credit to continue spending as much as they've always spent. So the market wasn't a huge fan of this data, particularly the PCE over the GDP, because of because that it wasn't great for Fed lowering rates. My kind of prediction now is that there'll be no rate changes until May, and then when Kevin Walsh comes in, I think then we'll start looking at lower rates. So I think we've got March is the next one with so we've got March with Jerome Powell, April with Jerome Powell, and then May he's gone. So we've only got 2 more opportunities to actually cut or raise anyway. It's 96% we keep the same, 83% we keep the same. It's a bit small, isn't it? Sorry. And then July, the 29th of July is the next meeting where June, the 17th of June is the next meeting where we'll have Kevin Walsh. And then who knows what will happen, because that is a whole different environment. George, what did you make of the PC data?
Yeah, it's exactly that. My main reflection after a bit of time to digest everything is it's that sticky situation. It's going to be the most time you ever heard the word sticky mentioned on live stream. That's that situation where they're stuck between, I mean, they're still growing and the GDP numbers were still growth, but they're slowing growth. And obviously it's all about forward looking and not being just in the moment, and what that slowing growth would look like if it continued on the same trend. And then on the flip side, having the prices going up, so you've got growth slowing down and then prices going up, and that's not usually either what happens or the situation that you want to be in, because usually when growth is slowing, you'll drop interest rates to increase spending to keep growth going. But actually, if you're looking at the inflation numbers, it doesn't look like dropping rates right now is a good idea at all. So okay, you don't drop rates. Well, do you rise rates and then try and combat inflation? But actually, then you're going to make the jobs sector and environment, as you said, that's already sort of struggling and asking for help worse, and probably put yourself into a recession and slow down that growth even more, make the growth become decline. So it's that situation of being stuck in the middle of, okay, for now let's not change anything with rates, and sort of maybe they'll be waiting to see how things play out. And I think for sure some of the inflation numbers that we're seeing that being higher than what they want to be is some of the tariffs come into effect as sort of stockpiles have run down for over the past roughly a year from when companies bought up stuff before tariffs came into play, and now stockpiles are running down. So now that increase in production cost or import costs is being applied into consumers, and that's driving up prices. So it's the same sort of opinion and viewpoint, which I kind of felt would be the case anyway coming into 2026, of at least some sort of a pause in rate cuts. But now I think I'm adjusting that to be a longer pause in rate cuts. I do think long term they will still have to go with something to make one of the trends change, and I think that will be to drop rates more and make some more rate cuts to benefit the employment side and that business and growth side. So it's just sort of what does inflation look like by that point? Has it worsened? Has it just got sort of stuck? And then does it make it worse? And so the inflation sort of 5-year inflation thing that we've seen for a while definitely isn't ending anytime soon by the looks of it.
Yeah, it's a difficult situation where there's a big push and pull kind of going on, and there's arguments for both, and it's not easy. And I think the easiest thing for Jerome Powell is 2 more meetings, just don't do anything. To be honest.
Yeah, maybe he's got the easy job actually, because he knows he's going anyway. He doesn't necessarily look too far ahead.
Yeah,
into
yeah, exactly.
I think on the back end of this, what you guys just been touching on as well, what was you two actually expecting out of the GDP? I know obviously you're talking about inflation as well, but I was sort of expect what happened. I sort of thought that was going to be the case anyway. What did you two think about that?
Yeah, I think it was mostly expected. That's why the market didn't react too badly overall, especially with the with the PCE, kind of how it went as well. I think we always knew that the government shutdown was going to have a major effect, and actually, I kind of heard it might even be 2.5%, which was sort of stolen, if you like. So the fact that it was only supposed to be about 1.15, I think arguably is actually a good thing. So I don't think the GDP growth rate quarter over quarter is that bad, to be honest. And as I said, it sounds bad because previously it was it's 4.4, and the consensus for this quarter was 3. But in actual fact, they're growing by far the fastest out of the G7. So I don't know, George.
Yeah, it being a lower quarter over quarter from the last one was no surprise, and like consensus was already that by a decent chunk. And like you say, with the government shutdown almost applying to most of the quarter, I don't think I really sort of foresaw how much that would really quantify into. But obviously, there's been lots of spending elsewhere. On the graph you showed, there was high consumer spending, high investment. The others were quite negligible. I think the inflation was the more surprising number over the GDP.
Yeah.
Yeah, agreed.
So yeah,
So
no
have you
more
got
rate
anything else
cuts.
you want to touch on that?
No, I was going to say just no more rate cuts. I think with Jerome Powell in charge, and then Kevin Walsh. Who knows? We could be down to 2%.
Yeah, could be well down real quick. But it'll be interesting to see what happens when Walsh comes in and how that actually plans out, because you don't know, do you? But we'll see. But I'd like to say we're getting closer and closer to April again. The ISA resets, and it's mad. Like I say, it's crazy that if we hit 2 for 2 years in a row where we've been able to have our ISA resets and been blessed, it'll be a phenomenal experience. I don't mind 200% growth again for another year. I don't mind it. I welcome it. Would you welcome Google back at 165, George, or what?
No, I don't want it to go down to 165. I want it to stay up above 300.
Like, it still seems so crazy when you talk about some of these stocks where there was literally like less than 12 months ago. I mean, some of where they were, and BBAI is back where it was. So some stocks like that are back there. But when you're talking some of the big names like Google and stuff like that, it's pretty crazy to see how much growth they've done this year, considering we've had 20 crashes.
Yeah, well, and I think that also plays into the fact that we can have some chop for a bit. We can have and it's fine to go sideways because stocks have grown a lot over the past 9-10 months. And I know it sucks a bit if you join the market only 2-3 months ago, but if you started, you're going to be doing it for 20 to 60 years. So it is what it is. I think it's better to start now than never. So you started now, it's a bit shit, but things will go up because it always does. It's the market.
And the thing is, people 20 years ago were probably saying that same thing to the people that were starting then, like, oh, look, I know this year's been a bit whatever, but in 20 years you'll be, and then the people 20 years time are saying it to the same people. You are right, the market, I mean, it's not guaranteed, obviously, but the market is always goes in a certain way over time. It's more about how much how consistent you can do with staying with something and how emotional you can be, and that's where the biggest investment comes in yourself, of making sure that you can not make irrational decisions every 5 minutes and changing what you're buying and what you're selling, and just formulating a plan and sticking to it.
That's a good point.
Mm-hmm. Right, George. US consumer sentiment. There we go. His little presentation.
Yeah, the PCE data and the GDP data leads into it quite nicely. And I will actually just say on that note, for anyone who has just started investing, I can share something in the Discord server, but I'm fairly certain that statistically, if you start investing in a bear market, you end up better off long term than those that start in a bull market. And that's because you're able to acquire a higher number of total shares in what you're investing in, obviously with a cheaper rate. So don't worry if you're just starting long term. Generally, you can end up better off than starting in a bull market. And for those who did start in a bull market, don't worry because you've made money. So it's happy days either way. So going into the consumer sort of sentiment, but also market in general, and why is it important? So the consumer spending or the consumer market is around about 70% of all of the US's GDP, sort of like the beating heart of it. The consumer market is effectively just anything that individuals or households spend on services, on products, on cars, furniture, holidays, entertainment. Basically the bulk of individuals buying from businesses and buying products and services from businesses. And it's been the main driving factor of a lot of the numbers recently. We saw just in the GDP data, the consumer spending was up 2.5% or 2.4%. It was the main gain. It was the main reason that the GDP growth quarter over quarter was 1.4. So it's a really important thing to be aware of and to monitor and to track. And I think the consumer market is sort of split into three key sort of considerations for it. It's the spending of the consumer market. As I just said, it went up 2.4%, and how much is actually being spent and how strong that market is. The sentiment, how people are feeling, what the outlook's looking like, what they think the future is going to bring for them, because that then affects everything else. And then also the financial health of the consumer market as well. So tying that into the others, spending being high is great. If spending's high, with credit being high, it's not as healthy of spending as spending coming from ample cash and economic sort of prosperity in individuals. So I think you need to tie all those three things together to really evaluate how you view the consumer market and its strength and the sort of like forecast for it. To look at a few of those sort of staples. So this is the S&P 500 consumer staples, and it's got a bunch of the biggest consumer sort of sector businesses there, and you can see the biggest ones. So the likes of Walmart, Coca-Cola, Costco, etc. Has performed pretty strongly in recent times, and as you can see from the end of that graph, very recently has performed quite well year to date and stronger than other sectors. Part of that, it does come naturally when people are talking about, as we mentioned, crashes and recessions and that sort of thing, and people flock to what these considered safe haven stocks. In the same way, gold is often considered safe haven against sort of like the dollar or just wider market crashes. Things like Walmart also often viewed in the same way, because in times of economic downturn, people still need the necessities. They still need food. They still need water. There are things that, unless you're sort of completely dry and have nothing left, you still do need to acquire, regardless of what their sort of financial situation looks like. You still purchase, and that activity continues much more than the luxuries of holiday and new cars, etc. So before we go on to sort of like the individual bits, we'll mention sort of the K-shaped economy and bifurcation. So that's where something basically divides into two branches, and this applies to anything, but of course we're looking at like a financial and stock market side. So when we see a division, the stock market, or in spending, or in just sort of the economic health, and where we see two very different trends, or a part of the same trend, two different focus points, or two different groups of people sort of tailing off into different areas, maybe one being more prosperous and the other one sort of suffering a lot more. So when we talk about it in like a stock and investing standpoint, we're thinking about a K-shaped economy. A K-shaped economy is exactly that, where we see two things sort of diverging away from each other, creates a letter K. Again, whoever named that didn't spend very long naming it. So for instance, here you see like an example where those who are richer are getting ahead of those who are poorer, and the classic term of rich getting richer and poor getting poorer is an example of a K-shaped economy. And then to pick out an example specifically from that we're seeing at the moment. So this is just a graph from TradingView with two sort of data points overlaid across each other. The red line is the S&P 500. So that's the market that a lot of us obviously invest in. that we've seen lots of bull runs and gains of momentum, and stocks getting higher and higher and higher recently, year over year, and great runs, as you can see. And then the blue line is the University of Michigan's consumer sentiment. So they do a monthly survey. They interview people. They basically ask them how they view their sort of current financial situation, how they view their financial situation going forward, and the environment around their finances, and just finances as a whole, and the economy. And then they give that a score, and that's tracked as well. And you can quite clearly see, without the sort of straight line at normal start of a K, you can see those two lines diverging away from each other more and more. And it's been happening for a few years. It's definitely not a here and now, this is suddenly happening. It's been happening for a while. But you just sort of see that get exacerbated more and more. And you see that very clear K shape, or that divergence away from each other, where despite stocks getting higher and the market index getting higher, the sentiment is dropping. So people's opinions and sort of financial stabilities and how they feel about money as a whole is getting lower and worse, while stocks are reaching all-time highs. So to look into one of the first bits on the spending side, and of course there's a lot of nuances and lots of different takeaways, but to just pick out one particularly, and again, this is an example of that bifurcation, that K-shaped economy, where one sort of trend happens and then there's an opposite trend on the other side of the scale as well. And you might have seen this already yourselves, but the top 10% of the share of spending by consumers in that consumer market, by how much the top 10% of those who are just their wealth or their income, how much they make up of that consumption. And you can see again a trend that's been happening for many years. It's not a here and now, but just to reflect on it, since 1992, let's go with, where it was about a third of consumer spending was done by the top 10%. It's now creeping up to 50%. So again, the rich are getting richer, effectively, you could say, from that. Those in the top 10% of income are spending disparatively more and more of the total spending than those the rest of the 90% below them. And that kind of comes in, I think, a little bit to the wealth effect, which I wanted to touch on, which is effectively just the idea around when stock markets keep increasing, people's portfolios grow, those that have assets and own assets, those generally that 10% that we've been talking about having a focus on, they feel richer, they feel that sense of increased wealth, they have bigger portfolios now, they feel able to spend more, and their spending then increases. So as you see stock markets go up, often you see spending go up because of that sort of sense of, as I say, of they have higher levels of prosperity, they have more wealth, so they feel like they can spend more wealth. And on the flip side, when stock markets come down, people's sort of portfolios, they see them crashing. And I'm sure we've all done this ourselves as well. When there's a streak of a bad day or a bad week, or maybe a few bad months in a row, you almost kind of want to make up for it a little bit by reeling in your spending and trying to make savings you wouldn't otherwise save, or sometimes some of your luxury sort of choices come out because you want to, as I say, either make up for some of the losses, or you're just feeling that sort of burn at your cash a little bit, even if you've not clicked sell, you've not realized a profit, and you've not clicked sell, you've not realized the loss. You still feel that, and it still has an emotional impact on you, and that feeds into their spending. So the wealth effect is just that overall thing where a rising stock market usually sees increased spending, and a falling stock market usually sees decreased spending from that psychological side. And then on the sort of health side of things, so this is just specifically looking at an example of auto loans for cars. And the yellow line here is showing the subprime of these loans. And subprime is effectively those loans who are, given to those at higher credit risk. Those that either have higher debt or have had the debt for longer, or they're refinancing it. They get basically worse terms. So they get them at higher interest rates, at different, less favorable time frames. So sort of more high risk debt, or debt that's reflecting a high level of subprime loans basically reflects the higher, almost desperation in a way, for the need to take on those loans, and also the people taking on those loans being at higher risk credit wise. They have less money, or they already have a lot of debt and loans and credit loans that they're taking out. So it kind of looks a little bit into the financial health there, where the spending might still be there, but the sort of numbers and the health behind it and the security behind it is worsening. And I think in a sort of the chronology of it is that spending will keep going. It will go from spending what they do have to then spending what they don't have until they can no longer spend what they don't have, and then spending stops. So it's just one of those sort of metrics he will monitor to try and, as always, try and sort of foresee and predict when the next recession might be and when next market crashes might be. And this isn't to say that it's around the corner. It's just to flag that that sort of health side of the spending is worsening slightly. I think as an overall, the combination of the three is that there's of course warning signs there in some ways. Again, not an imminent threat of this is about to be a crash settle now. That's not at all what it reflects as, and not at all what I'd be saying for anyone to do. There are strengths, as our overall spending has increased and spending is propping up a lot of that GDP growth numbers that we've seen, as we mentioned. The sentiment is declining, but it's been declining for a long time, and not a lot of these trends are sort of brand new. So I don't think any of them are to react to immediately. Again, this graph that you see on the screen now is looking over a number of years, and it's been increasing for a long time. So it's not a sudden change. It's not a sudden red flag at all. It's just how these shift and monitoring them, I think, how they interact with each other, as I say, using those three individual points as like a matrix of how you almost score and view that consumer index yourself. Because, as I say, it's such an important part of the economy. It's more or less the center and the beating heart of it. And when consumer spending tails off, everything else does, because it is almost a definition of economic activity and the money moving around, which is ultimately what you need to see everything else benefiting. And then I might just go back to the sort of K-shaped economy side of things. And as I say, the sort of the reflection basically of those that are owning assets are the only ones really benefiting, and those that don't own assets are sort of disproportionately getting worse off in the meantime. And we've said this in a number of weeks recently, but I think there's so many examples where you can see that flag and that highlight of how important it is, if you can, to own as many assets as you can, because times like this, owning assets is what benefits you. And those that are disproportionately on that sort of downward trend, those that see that sort of sentiment drop, and those that aren't there to benefit from that red line on this graph going up, are those that don't own the assets and those that aren't able to. There's a lot of focus on the top 10%, but I do think it extends and applies beyond that. And as I say, those who benefit from that red line going up are the ones with assets, and those that are suffering from that blue line going down are the ones without. I'll leave it there because I don't want to talk too long about it. And obviously that's a very quick overview of some parts of the consumer market, some of the sentiment side. There's a lot more to look at for sure, and there's a lot more that we could talk about as well. Just those are the few I wanted to highlight and run through. So if you have any questions, send them through. In the meantime, Will, I don't know if you have any comments on that yourself as well.
Yeah, I'm sort of like I'm just sort of taking what you're saying, and it's just, I think it's unfortunate that the way capitalism is kind of designed, that it just naturally happens over time, that those people who do own assets benefit from the compounding over time, over decades, of gold, silver, Bitcoin, stocks, etc., and it just compounds massively over time, and that is always going to benefit the people who own assets. And people will buy into capitalism less if they're not benefiting it. If they're not seeing, if they're not feeling that the benefits from it. And not to take it down like a political discussion, but I'm just saying, like, this was always sort of going to happen from 50, 60, 70 years ago, because this is just sort of just what happens. But kind of moving on from that, I also just get like the general sense that, and I have said this on other weeks as well, that we are heading towards a recession, a market crash, but we always are, because crashes are a feature, not a bug. And as I always say, like, these things take years to unwind, and there's so many signs that something's coming, like a recession, an AI bubble, both, whatever it is. But this could still be 5 years away. But yeah, I think quite clearly from the data you shared, Jordan, we are heading towards a bad time for the stock market, but I don't think it matters really to us. Well, like as in us three and the people who we know watch, because we're all generally young, and it just means that it's a good time to buy. So no, it won't feel pretty. I'm not celebrating anyone losing their job or anything like that. But purely from a owning asset stock market point of view, a crash will come because it always does. And we know we just got to keep our heads screwed on and just keep buying.
Yeah, I think that's a very fair take. And I just want to quickly drop something in there before you boys carry on as well. I think obviously you boys bring some absolute gems every week. Jordan, I know you take a lot of time building those as well. And you will getting all the data together for the Dixie and the Bitcoin and everything. And you bless everybody on a Sunday at your own time for free. So I appreciate the effort you both put in, because you both bring gems every week. And I know a lot of people take a lot away from these streams.
Appreciate that. Thank you.
Oh, thanks, mate. I wasn't expecting that.
No, so I was going to say before you started doing it, man, because I was just dealing with a couple of people who have joined. People are joining the server from the stream, and obviously there's that bug at the moment. There's that bug with the verifying thing, isn't there? So I've been having to do it whilst you were talking. But listening to the information that you lads put in, it's a lot, man. You put a lot in there, and I know a lot of people take stuff from there because you make it simple but effective. So no, I appreciate it. Is there anything else you two wanted to touch on the US consumer sentiment side of things?
I'll just say in response to what Will said, I think it's a really good way to view it and think about it in terms of the recession's always coming, because that is the very nature of it. As soon as one's finished and you're enjoying the bull run, the clock resets and there will be one that comes next. As Will said, it's a feature, it's natural and you need it. And I think a big part of investing is sort of just accepting the fact that at some point, sooner or later, you will experience, if you're in the stock market for more than 2-3 years, there's a good chance that you will experience a recession. If you're in it for a long time, then you will experience a recession, and it's not something to try to avoid, because I think you might end up costing yourself more in capital, more in your portfolio, trying to dodge it and trying to guess things that you don't know, rather than just accepting it, weathering it, and sort of managing it and responding to it as best as you can. Is the sort of healthiest and safest way to approach that, just on the wider point of recessions being a thing. So regardless of when you think they're going to come, just know that they will, if you're going to be investing for a decently long time, which I think everyone here does want to be.
Yeah, and just to clarify that, when I always say just to keep buying, I am talking about like an index fund, like a global index fund, or maybe like the S&P 500. Like, obviously I can't say to keep buying a certain stocks during a XYZ recession in X number of years, but that's why it can be good to have 10, 20, 50, 70% of your portfolio in a broad market index fund, because you can truly say for that, you can just keep buying it, looking at the historical data, knowing that it will go up over time. It might be a messy 1 to 3 years, but just keep buying it and just lower your average and things will be up. So yeah, I just want to clarify that obviously individual stocks are different, but if you are buying a broad index, then I think you're sorted. And I think also it just takes off a lot of stress as well. So even if you haven't got one, maybe even putting 5-10% into ACWI or I don't know, like a VUAG or something like that, can just take a little bit of stress off, just knowing that you've got that anchor in the portfolio just there. Yeah, just there waiting for you.
Yeah, and I think like what you both touching on there, which makes total sense as well, is the fact that cycles are a thing and they happen, and it's about preparing yourselves for them. And the longer you're in the market, the more you get better at reading the red flags, reading the alerts, reading when something's going somewhere. And of course, you're going to make mistakes. There's going to be lessons that's learned, but if that's part of the journey.
Yeah, 100%. And I'm totally fine to be a broken record and say this sort of thing most weeks, because I think it is important just to stabilize our thoughts. There's always noise, there's always shit going on in the world, but just zoom out of any major index, it goes up over time. So, yeah.
Favorite OBJ saying, if in doubt, zoom out.
Yeah, exactly. It works, doesn't it? It absolutely works. And I think that kind of leads nicely on to what I wanted to talk about. So obviously at the moment, there's quite clearly a massive military build-up going on, ships, planes, like basically you name it. The US ascending to like the Middle East area, let's say. I think obviously we know what the target is, but I think there's a general confusion of why the US is going after Iran to an extent. I mean, obviously we know that they bombed the two nuclear sites. The three nuclear sites last year. But I wouldn't say that there's a clear reason for the biggest military buildup in that area of the world since since 2003. Is there really? But certain people often sort of focus on certain things. So I know a lot of focus is put onto the government shutdowns, which I said 2 weeks ago, yeah, sure, we can pay attention to it, but it isn't that important. And also certain focus is put onto these military events, which again, I also think that they're good to know about, but not necessarily like the be all and end all for the stock market. So, Jay, can you just whack my screen back on the screen again? I just wanted to have a look. So, if we just think back over the last 3-4 years, we had Russia invading Ukraine. We had a mass going over the border into Israel, and we had the US bombing the three nuclear sites in Iran. So, the Russia invading Ukraine, that was on the 24th of February 2022, which is this dip here. So basically, the point I'm trying to make here is, yes, there was a dip, and the dip was about 7% ish over the period of about 1-2 weeks. So it is like a fairly sizable dip. But the point I'm trying to make here is that, yeah, we went down on the day it actually happened, and then by Friday we're already it's already like a fair way back up, and then by the end of the next month, so about 5-6 weeks later, we're quite a bit higher. So if we just measure that as well, just so we know what we're talking about here exactly, that's about plus 13% over the next 6 weeks. So this is the Russia-Ukraine dip. Now, if we go over to the 7th of October 2023 for Israel Hamas, where are we? So that is here. So this happened on the Saturday, I think it was. And then that dip was a little bit longer. So that was a period of 24 days. It went down just under 6%. So again, it is something to be aware of, but look how quickly the rebound happened again. It was like as a perfect V. So I think generally these are buying opportunities as opposed to a time to be worried or scared or like generally to sell. And then finally, I think it was the 24th of June was when the US dropped the bombs on Iran. That is, yeah, there we go. It's this little dip here. So from the high to the low, 15 days down 2.2%. So again, if we look here, this was basically the last major buying opportunity before like a next massive leg up over the next 1 to 2 months. So overall, I'm making the point that let's keep an eye on the news. I see what happens, and this will affect oil prices for sure. So it is something to be aware of. But I don't think that these military events are the be all and end all. Of course, unless something major happens, like if China invaded Taiwan, I think that's definitely majorly market moving. But these more minor, well, I guess it's a bit of an insult to say Russia Ukraine is a minor. Yeah, so I said yes. I suppose it's not a minor kind of conflict, but not these major global things, because overall they don't massively affect the stock market. Is that your broad take as well, Jordan?
Yeah, they're often short and sharp, aren't they? And I think it's
Yeah.
maybe a reflection of when fear is sort of the leading reason behind a move, or rather than actual numbers or actual sort of quantifiable impact, and that's why it kind of fades off fairly short term in terms of what we normally see for the stock market and its moves, and then gets replaced very quickly as well. Yeah, of course, as you say, there are examples and potentials that would be slightly different, but often it is that as I say, that fear being the leading reason, and exaggerated fear kind of beyond what really is the impact numbers wise, which of course, I mean, it's overall it's a numbers game. So if the numbers don't really change, then things will find their way back to where they should be.
Yeah, and I'm sure we'll see a dip of some kind if like the US launches I don't know, like multiple strikes on Iran, but the chance of them putting boots on the ground there to me feels extremely slim, if not impossible. So I can't see a major conflict. Obviously, any loss of life, any military action is significant in some sense, but rather trying to take it in that direction, focus more on the actual stock market. I think it's a buying opportunity rather than a time to be worried or concerned about where the market will go.
Yeah, I agree with both takes on it. Like I say, they're normally short and sharp, aren't they? So it's an interesting take on it for sure. But you would never really know what's going to happen with the whole Iran tensions and stuff like
For
that.
sure.
It's so on edge now. If you just tomorrow you could have something that kicks off full scale, or it could just be we've sorted a deal out, we've got a trade deal in place, we've got this in place, we've got that in place, blah blah, blah, and everything's
100%. Yeah.
so. You two, have got anything else to touch on that, or?
Well, I do think it does add a slight element of complexion. The fact that there were just being so many resources being sent to the area,
Agreed.
and if you ask sort of like just like if you just ask like a normal person, why is the US doing that? I don't think the average person could give a clear answer. I'm not sure I could give a clear answer because like there isn't a definitive reason as to why. And obviously we know that ultimately the US doesn't want Iran to get nuclear weapons, but it's not like they've launched a nuclear weapon or they've tested one or like something really tangible has happened. So I think that adds a slight complexity because the market doesn't like not to know why something's happening. But yeah, I mean, let's just see how the next kind of week plays out. I think if nothing happens over the next 2 weeks, then I think we should be in the clear because it does feel very imminent if it does happen. So yeah,
Yeah,
we'll just see.
agreed. We'll give an update on it next weekend when we're
Yeah,
here
I'm
again.
sure.
So before we touch on the next one, we're going to touch on this quickly, of course. So I'll read it out and then I'll say what I know you're going to say, and then I'll let you boys touch on it as well. So Nicole asks, just out of interest, which 3 ETFs would you advise? I'm going to tell my daughters instead of buying a coffee every morning, bring one from home, and I'll put the equivalent into an ETF. Now, obviously, we can't give people financial advice to tell them what to buy, but we can tell you what we buy. And I don't know if we're going to have free to share because I'm pretty sure we're going to agree on. Well, actually, you might say the S&P 500. I mean, if it's three for me, it's either an ACWI or an FTWG, which are pretty much the same, but ACWI is slightly better on a contrary of things. And then if you wanted to put a third one in there, you're looking at like an S&P 500, depending on what you'd like to look at. I know you was going to go into your greatness here, Will. So if you want to give a quick touch on this real quick as to.
Yeah, well, if I like, so I do know you said three, but I think
Two is probably.
Yeah, probably like one or two works best.
Mhm.
I think ACWI is like the gold standard. It's a great global index fund, so it tracks the MSCI All Country World Index. It's 90% developed, 10% emerging, and it's got a great track record. It slightly beats the other global indexes, which is FWRG and VWRP, both here. So
And we are going to do a stream in a couple of weeks at some point. There's just so much going on at the moment, but we are going to do one at some point based around ETFs.
So if I had to say, I'd say 100% of this, but if you really wanted more, I would say something like 95% this and maybe slight overweight to the UK, and you could go for CUKX, which is the FTSE 100 fund, and then you've got a slight overweight, and then you're reducing your currency risk as well.
But yeah, there you go, Nicole. I hope that figures your answer. But like I say, we will do a full breakdown on that in the coming weeks when we get some time to do it. So moving on from that, we're looking at the week ahead. So obviously, this is my more time to shine here. I should have had that ready. I got too engrossed in that conversation. So obviously we've got the earnings. Let's pull this up. Share screen.
It's a big week. There's a
so
doing earnings.
So there is a lot. So obviously we got HIMS on Monday, which will be interesting to see what happens there. We've got your Salesforce and Nvidia massive this week. Probably not the greatest week with everything going on. We've got Trade Desk, Snowflake. There's a lot going on there, lads. So where's we got Zeta as well. I didn't realize that. So we got a lot going on this week. Where's your thoughts on that, lads?
Yeah, well, just on Monday there's the third one down, Kratos. That should be a good one, and more so for you guys because that's a bit like an Ondas competitor, isn't it?
I believe so.
Kind of anyway.
Yeah.
So yeah, we got Kratos Monday. HIMS have not been doing well recently. Like the stock prices, I think it's like 16, 17 now.
Yeah, got a lot going on.
Yeah, so that'll be an interesting one. Tuesday, Mercado Libre for me, my South American big boy. That will be very interesting how we do there. And then Wednesday, Nvidia. I expect a gigantic quarter, a mammoth quarter, possibly like the best quarter we've ever seen. But I don't think with everything going on, it's gonna massively drag the market one way or another. Like maybe for like 5-10 minutes, but I don't think even with a beautiful quarter, which we're going to have, is going to have the momentum to drag everything in one direction or the other. And then we've got CoreWeave Thursday as well.
Yourself, George?
Yeah, there's nothing that I am investing into directly in this week. At least not, as they're not directly. I've got obviously exposure to Nvidia, for example, through ETFs and stuff. I'm interested on Tuesday, Leonardo. They've also got quite a big sort of anti-counter drones sector and what that's doing there. There's like a different realm to Ondas, so not a direct competitor, but sort of a bit of an indicator of market space because obviously they're a huge company. Yeah, I think I'm looking forward to this week. I just thought it was a big week for Will for sure with Mila, Nvidia, Trade Desk as well.
For God's sake.
And then Thursday, Duolingo. There's quite a few people on the server that have held some since that big drop off on the last earnings, I think it was actually. So it'd be interesting to see how things have changed in those 3 months, if they have changed and where it goes from there. But yeah, nothing that I'm interested into directly myself. So just more relaxed, sit back and watch and see what they mean for the stocks I am in.
Yeah, I was just about to add to that. I didn't see Rocket Lab was chilling in that little gap there. So we've got some pretty interesting ones on Thursday for market sentiment around other ones. So you say your CoreWeaves, your Rocket Labs. I've seen obviously Warner Brothers down here as well. I think obviously a lot of Netflixy holders might be watching that maybe because of an acquisition obviously down the line. So like I said, I think we've got a huge week this week. I thought we were starting to slow down a little bit, but obviously it appears not when I've seen this over the weekend. So some huge ones. So I'm pretty sure we're gonna have a segment from yourself next week, Will, on Nvidia.
Yeah, so actually we've got John covering the financials of that, and then John's also going to look at Zeta as well. So we've got at least 2 kind of breakdowns on earnings next Sunday.
Happy days. That's great to see. Right, so on the back end of that as well, we've got a lot going on in the events next week. So I know it's a bit smaller there than every one. So we've got market reacts to Trump's 15% global tariff, February consumer confidence data, Nvidia, and obviously reporting earnings on Wednesday, jobless claims Thursday, PPI on Friday, and we've got 11 Fed speakers speaking this week. So what do you think about the week ahead, Will?
Yeah. So firstly, futures tonight, we'll see kind of where we're at. I think we'll probably be about 0.2 down over the weekend, kind of tariff stuff. And and then sort of see how the market opens on Monday to the global tariff thing. And then ultimately, I think it is probably more so about earnings this week. Obviously, jobless claims matters. Obviously, like the PPI matters as well. But I mostly will be focusing on like the general earnings, really. Jordan?
Yeah, similar. Inflation always key for me each week for sure, and it feels like it's week after week more inflation data.
Yeah.
Otherwise, yeah, of course, still in the thick of earnings season, so still watching those is like a big focus there. As I say, not directly invested, so more what I can take away, more what I can sort of feed into for stuff I do own, and obviously if anything changes in terms of being a buying opportunity, also watching that as well. I think that's a big thing. Is don't be complacent just when your stocks aren't coming up. Always be watching, because you never know what might come about.
Yeah.
No, I agree with that. Like I said, I think next weekend we're going to have a lot to cover as well. So I think it's going to be a very, very action-packed week. So I think the most important part, the most exciting part, because we like to talk about this on next week predictions. So Jordan initiated a new rule. So obviously, you are to go first, and we'll do top down. So what's your vote, mate? Where you at?
Yeah, so I think there's sort of two sides to it. So I think we'll open a little lower because of the tariff news.
Mm-hmm.
If the US bombs Iran next week, the market, I think, will be red next week.
Mm-hmm.
If the US doesn't bomb Iran next week, because we'll open lower, I think the market will finish green. So to me, I'm sort of deciding, is the US going to strike Iran this week? My sort of head, well, not my head, sort of like part of me says no, but then part of me says, well, surely they are, because they got so many troops, planes, boats, ships, you name it there. So I'm just spilling out the logic for everyone there, in case you're wondering what my thoughts are, and trying to buy myself a little bit of time to go with a guess of, I think they're not going to strike, so therefore I think the market will be green next week because we're going to open lower.
So my mindset is pretty much the same as yours. I think we open up lower after this weekend because of all the drama that's gone on. I think obviously next week we've got a lot of earnings there. I feel next week's going to be a really good week of earnings. I think we're going to have some good results in there. So as long as that's good and the guidance is good and the sentiment is there, that will keep the market propped back up from where we open up down. But the thing that's playing in my mind is the same as yours, whether we get Trump at 9 o'clock on Friday night, put something out, 8:30 or whatever, and put something out where it drags it right down to the last minute. We don't know. That's my consensus. But I am also going to go with green next week. I believe we will, because we're starting lower. We'll get John's on it off him after as well. And then George, where's your mind at with it?
No, I'm going green. I'm not going to give too much thought to it. I'm just going to say green. I do think I think from a earnings standpoint, Nvidia's will be good, and if you believe in Nvidia, that it will bring up some of the tech side a little bit and pump it a little bit and feed into some of the green stuff. For sure, I agree. The same reasoning. If we do see any escalations over in the Middle East, then things will have those typical short, sharp dips, I think. So it does for sure sort of leave a little bit there. But I'm just not thinking too much this week. I'm just saying green.
Yeah, no, that makes sense. And then when we look at the chat itself as well, so the stream, so 61% green and the rest was red, so nearly 40 votes. So the market has gone green as well. So yeah, we're all sort of in the same boat there. So again, I really appreciate everybody joining us for this Sunday evening. It's been one big stock market Sundays with me and the boys again, as always. Next week's going to be a massive week, so put that one in the calendar. And lads, is there anything else you want to touch on before we go?
No, all good. I think we had a busy stream because we had a busy week, and I think it's a busy week next week. So I'm looking forward to next Sunday.
Yeah, we're going to have a lot of prep to do in the background. So yeah, next Sunday we'll see you all back here at 8 p.m. We thank you all for joining us, and we'll see you next week.
Cheers, guys. Bye-bye.
See you later.